Hi everyone and welcome to this recording. In this recording, we'll discuss the basics of financial modeling and we'll discuss the format that we're going to follow. Now, financial modeling is useful if you're projecting your business's revenue and calculating a value for that business. It is also useful if you're making decisions whether to start a new product, whether to buy certain machine parts, make some changes. So, financial modeling helps you to make decisions, right? So decisions can be to start a new product, start a new product line, then maybe start a new business vertical, expand geographically, all those things, right? It also helps to value your business. So what is the value of my business? If I go out and sell my business, at what valuation can I sell it? Also, if I go out and raise money as against my stock, how much money can I expect to get? So valuations are important because of that. So what are the steps of valuing it? So any business is always valued based on cash flow. Any business is always valued based on cash flow. So I'll highlight it in different color. So it is valued based on cash flow. So you have to project cash flows. So you have to project cash flows across different years, right? And then value the business, right, based on that cash flow. Same way, any decision that you make to launch a product, to maybe start a new product line, expand geographically, get a new machinery, all of that is based on cash flows. If the present value of cash flows is more than the cost of doing that, then you would accept it. If it is not, like if the present value is less than the cost, you will reject it. So it's a simple binary decision. So once again, all businesses are valued based on cash flows. Okay, so cash flows helps you to value a business and make decisions in a business. Okay, so how do you make decisions? If present value of cash inflow is greater than cost of the project, we accept it. If present value of cash flows is less than cost of the project, we reject it. Okay, so in this recording we are going to discuss different steps of finding it out and then we'll do some problems based on that. Okay, so the format for doing financial modeling or creating some projections is this. So you have year 1, year 2, so on and so forth. Okay, then you have some items where you get to cash flows. You start with sales, right? What are the sales that are happening? Then you have cost of goods sold. Then you subtract cost of goods sold from sales, you get gross profit. From gross profit, you subtract SGA, selling and general expenses. You subtract research and development expenses. You subtract depreciation. In Canada, it is also called as CCA, capital cost allowance. Okay, you subtract depreciation. Then you get EBIT, earnings before interest and tax. You deduct tax, right? You get earnings, right? You get net income. You get unlevered net income. Why it is called unlevered? Because we are not deducting interest. We are just deducting tax. We do not consider interest when we are doing valuations. The reason being, we use interest as a discount rate. So we do not subtract interest from EBIT. We just subtract income tax. So income tax at whatever is the corporate tax rate given. Okay, you get unlevered income, but we do not value a business based on income. We value the business based on cash flow. So from unlevered income, we have to go to cash flow. So how do you do that? You add depreciation. So CCA is also called as depreciation. So you add back depreciation, you reduce capital expenditure, whatever you're incurring, and you reduce increase in working capital. So increase in net working capital, you reduce it. So if the working capital is increasing, you reduce that. If working capital is decreasing, you add it back. Based on that, you get cash flows. So once you have cash flows, you find net present value. How do you do that? You find present value of the cost, and you calculate present value of different cash flows. So based on that, you get net present value. So once again, for valuing any business, right, we need to know about cash flows. So cash flows can be used to value a business and also to make decisions. So we are going to do problems based on valuing a business as well as based on making some decisions. How do you make decisions? We accept a project if present value of cash inflows is greater than cost of project. We reject the project if present value of cash flow is less than cost of the project. So that's how we do it. So steps to do that: make projections for given time frame. So make projections. So whatever number of years is given, make projections for it. Then calculate terminal value of cash flow. So in the last year, we also compute terminal value of cash flow. We'll see how to do that. Or if it is a decision, calculate the salvage value. So sometimes the salvage value is 0. So in that case, consider 0. Then use net present value function. We'll see what the function is. Use net present value function to discount the cash flows. NPV, the present value you get is the valuation of your business. Or if you're making decision, compare it with cost. If it is greater than cost, we accept it. If it is less than cost, we reject it. Okay. So in the next part, we'll start solving some problems based on this.